So we're with our show today. We always start with the phrase or word of the day, and it's two words today.
It's a two-word word of the day, all right? So the word of the day today is double taxation. Double taxation. So, but before I get to it, let me back up. Today's show is going to be a little different. We're going to talk about business entities.
Okay.
Different types of businesses that are out there. In the reason being, my brother is he's starting a new donut shop in Lexington.
Okay.
And as you might imagine, being a lawyer, I get to give out tons of free advice to my family, and that's.
Does he pay you with donuts?
Well, he hasn't yet, but
starting a donut shop.
That's right. That's right. So he and I have been having all these discussions, and I thought, I'm sure there are other folks out there that are curious about the differences between partnerships, corporations, S-corps, LLCs. What does all that stuff mean? So thought we would talk about that in general, and that brings us to the word or phrase of the day, which is double taxation. So here's what that means. In the United States, when a corporation, and I always like to pick on Walmart when I talk about corporations, when a corporation makes $1, they have to pay taxes on that dollar. Mm-hmm. So dollar comes in, 36 cents goes to the government. I'm going to round it to 30 just to make the math easy. That leaves 70 cents left. Now, something that people don't really think about all the time is who gets that other 70 cents? Who owns Walmart?
Okay. It's a stock owner.
It's the stock owner. That's right. It's a corporation.
Okay.
So the shareholders of Walmart get to get that money. And that could be me or you. We could go in the New York Stock Exchange and buy some Walmart stock. So then when that 70 cents comes over to the owners of the business, well, they just had income. And so they get taxed again. Another 30 cents goes away. So that leaves 40 cents in the actual pockets of the owners. So that same dollar, $1, got taxed twice before it made it to the owner of the business. And that is double taxation. And as we talk about some of these other things this afternoon or this morning, you'll see that has prompted the creation of these other entities. How can we get around double taxation?
Yeah. And then the other thing, of course, with capital gains type taxes, if you don't cash that stock in and it increases in value like everybody wants their stocks
right.
to do, then you'll pay the capital gains of it.
That's right.
When you sell, I think that's right. I try not to do that very often. All right.
I saw the light blinking. I didn't know.
That was our business.
All right.
So double tax, and that is something that, as you pointed out, has created legal means to try to
get around it and yet still have folks be in a business. So the way they teach this to us in law school is they always start back at the very beginning with partnerships.
Yeah.
And that was the first sort of way that folks came together to make a business. So you and I want to go into business. We're gonna do radio and lawn care. You're going to be in charge of the radio. I'm going to be in charge of mowing the grass, and we're going to go around and do this for folks.
And you'll notice we have, besides the weeds, we have the rock around here.
Right. That's why I chose that. I figured it's no work for me.
No work.
So all we have to do is sort of say we're in business together, and we are automatically in a partnership. And folks don't realize this, but there's actually a default partnership agreement. Even if you don't put one in writing, there is one out there in the law. The Revised Uniform Partnership Act, it allows you to create whatever you want to create. You can have whatever deal you want back and forth with someone, but if you don't have one, this is the default rules.
Okay.
And one of the important things that happens in any of these businesses is it creates duties between the people. Mm-hmm. So if we go into a radio and lawn care business, if somebody comes up to me on the side and says, "Hey, Chad, why don't you come mow my grass, and rather than have to split that with Roth, I'll just pay you on the side." I can't do that because you and me are in this business together, and I owe you a duty and you owe me a duty to have any corporate opportunity become our opportunity as long as we're in business. And they call that a duty of loyalty, and you'll see that duty of loyalty pops up. So the world kind of went on with these partnerships and everything was great. Except, what happens if you're on the radio and you make a horrible mistake and end up getting yourself sued.
Mm-hmm.
Now, all of a sudden, you get sued, and I'm going to get sued. And in a partnership, everything we own is on the line. So our houses, our bank accounts, all of our assets, so everything we have, and I'm now thrown in with you, you're thrown in with me, and there's no way to limit our liability.
And what if you mowing through a rock through a window?
Yeah, or worse, my mower blade chopped something up, that's where you really could get into some liability there.
I was just trying to point out that you could make the mistake.
Right, and that'd be more likely than the radio.
In our conceived partnership. Okay.
So that then led to the creation of corporations.
Okay.
And corporations are I always call them, they're creatures of statute. They exist because we say they do. I mean, we just made up a law that says, hey, there shall be something called a corporation. And what's interesting about a corporation is it's a way for people to get into business together and have limited liability. In other words, you throw in $1,000, I throw in $1,000, we'll go out and we'll buy a new lawnmower. That lawnmower will be owned by the corporation. And if we throw a rock through somebody's window, they can't sue me or you. They have to sue the corporation. And if we lose, let's say it was a fancy stained glass window and it cost $5,000. Well, we only had $2,000 in the company. That's all we can lose is what we had invested. So right out of the gate, everybody thinks, these things are great. They have limited liability. The other interesting thing about a corporation, especially when you compare it to a partnership, what if you decide you don't want to be in business anymore? And you say, you know what, I think I want to get out, but I still wanted to keep the business going. Well, in a partnership, the second you want out, the partnership is done. It's over. It's dead. We have to wind up the business. That means sell the assets, pay the debts, and move on. I would be free to start a new business, but it wouldn't be our old partnership. With a corporation, on the other hand, sort of comparing these, a corporation will continue in existence, and if an owner wants to sell or get out, they can just sell their shares. And so that ease of transferability was a huge change. And all this kind of happened way back at the turn of the last century, the 1900s, which kind of then led to the creation of Wall Street. That's what Wall Street's all about, buying and selling ownership of corporations, buying and selling the stock. But the problem with corporations, and that was the word of the day, was the double taxation. So our little business, every time I go and mow a yard for $100, the corporation has to pay $30 to the government. That leaves $70. Me and you split that up, $35 each. We each have to pay
income tax.
So now we're really wasting a lot of money because we chose to be a corporation. And so you were forced to try to pick, gosh, is it worth having the limited liability because I have to give up so much in taxation? So that kind of led to the next big change. And a lot of people know this word, subchapter S, or an S Corp. You'll hear that all the time. In S Corp, and the reason it's called subchapter S, is because it is found in subchapter S of the Internal Revenue Code. Okay. So an S Corp is really just a regular corporation, but it's one that meets certain requirements found in subchapter S that are, you have to be really small, like you can't have, and I'm making these numbers up, I don't remember off the top of my head, but you have to have like less than 100 shareholders, for example. So it can't be the Walmarts of the world who have hundreds of thousands of shareholders. And the thought is we're looking at small businesses, family-owned businesses, people here in town kind of businesses. What we're going to do if you meet the requirements is we won't tax the corporation. So the corporation still has to tell the government how much money it made. So we made $100 last week, but now there's $50 there for each of us because we're 50-50 shareholders. And then we're going to get taxed, and we're only going to get taxed once. So that was a great, great thing. The problem with the S Corp, though, was that it wasn't very flexible. So let's say, for example, our deal is we're 50-50 as far as ownership goes. But since I'm the one out there sweating, mowing the grass, you agree that for any lawn job that we do, I'm going to get 70% of the money and you're going to get 30% of the money. But we still want to be 50-50 as far as voting and ownership. Well, you can't do that in an S Corp, because in an S Corp, it has to follow the shareholders. You get to vote however many shares you have, and when we distribute money in the form of a dividend, it goes with the shares. So if we wanted to be 70-30, I would have to own 70 shares to your 30 shares. But then when we go to vote, I would have 70 votes to your 30, which means I'm getting control, and you're not going to want that. So they were really, really tough on the flexibility angle of them. So for years, though, from I don't even know when, until 1998, that was your only option to have single layer taxation and limited liability. Until 1998, then we create the limited liability company, the LLC. And nowadays, most folks will come in the law office and that's the first words out of the mouth. I need to start a business, I want to do an LLC. I don't even think they think about S Corps anymore, or partnerships, or joint ventures, or any of the other possibilities. And that's really with good reason. The LLC has the exact same limited liability that both the corporation and the S Corp has. It has the exact same ease of transferability. That is, you can sell your interest in the LLC to somebody else. You can leave it in your will to somebody. But the really neat thing about them is they're flexible. So we can create our deal however we really want to. So we can say, voting, we're 50-50. But for the first 5 years, I get 100% of the profits, if there are any. And then for the next 5 years, you get 100%. And then after that, we'll split. Just any sort of creative thing you want to get into.
It's as long as it's in the LLC corporate charter or
exactly
in the agreement.
In the agreement in this case is something called an operating agreement. And the operating agreement, kind of like the partnership agreement, if you don't have one, there is a default one under the law.
Okay.
The statute says, and it's really interesting, they always start, unless otherwise agreed. And then, for example, it will say, unless otherwise agreed, the LLC shall be controlled by its members according to their percentage of interest. So you vote according to your percentage. But again, that's unless otherwise agreed. We could change that however we wanted to change it. The other great thing about the LLCs is you're allowed to have just a single person. So you don't have to have a bunch of partners. You don't have to have the operating agreement written. There's the standard one already there. Unlike the S Corp, there's no restriction on the number of members that you can have or anything like that. So they really are kind of the best of all possible worlds. But I got to caution everybody here. For any of these entities that have the benefit, if you will, of limited liability, it's really important that you play by the rules. Because the rules, the statutes say, you shall have limited liability. But they also say things like, you shall have an annual meeting. You shall have a meeting anytime you're taking corporate action. So I encourage the folks that I set up LLCs for, you've got to have an annual meeting, even if it's just you. If it's a single person LLC, you've got to be a little schizophrenic with yourself. There's going to be a day out of the year where you want to fill out your annual meeting and your annual report, and you want to stick it in your minute book. And if you decide, if the LLC decides, let's say for example in our business we're gonna buy now a new truck and trailer. Well, that's a pretty big deal, and that's not something we do every day. So we would need to get the approval of all of the members of the LLC by a resolution to do that. Okay, I'm the only member of the LLC. I approve. Well, you need to write it down and put it in your minute book. Because the first time you get into an accident, and the attorneys like me come chasing you, we're going to want to pierce through that corporate liability veil. And that's what we call it, piercing the veil, to try to get at any other assets we can. Because, we're representing somebody that's been horribly hurt. You've only got a little bit of insurance. They're entitled to everything. You're the one that did this. And the first thing I'll ask for is, let me see your minute book. And if you can't just, reach on the shelf, hand me your minute book, then I know you're not a real LLC or a real sub S or C corp. And if you're not real, you don't get the benefit of the protection. So you have to think, okay, what would Walmart do? What would Google do? They're going to have meetings, they're going to have minute books, they're going to do all that. You have to do it as well, no matter how small you are, which makes people feel weird.
Yeah. And you don't have to have a big to do about it.
No, that's right.
You just have
and I tell people, look, pick a day. I don't care what the day is, but just say this is the day we do it. And it's really nice too if quarterly you'll kind of go back through and say, okay, what are the things that we did this quarter that were different? Oh, well, we bought that new truck. In addition to mowing yards, we decided to take up snow removal. Go back to your minute book and write a resolution. And I give everybody blank resolutions that says, on this blank day, fill in the date, the undersigned, being all of the members of the LLC, agreed to the following. And then you just sort of put bullet points down. Sign it, stick it in the book, and you're good to go.
Okay. You mentioned LLC. I see every once in a while some other initials with people in the service sector. What is it? Is it
PLC and PLLC?
Okay.
So and there's also a PSC. Anytime you see the P, that stands for professional.
Okay.
And under the statute, there are certain categories of jobs that are allowed to have the P designation. Attorneys, doctors, engineers, some of the usually graduate level degreed jobs, you get to add the P in front of your name. No other significance.
Changes other than that.
Right.
Okay.
It does limit the business. The business can then only engage in that professional area. So, for example, my law firm, we have a PLC, Professional Limited Corporation. It's the same as an LLC. It's just they let us get the other L out of there. We would not be allowed, for example, to
start a lawnmower business.
That's exactly right. I mean, we just wouldn't. We have to stick with law.
You could start a lawnmower, but it would have to come under a different
Exactly. Yep.
Okay, and meet those guidelines.
Now, sorry, I didn't mean to interrupt. You had a question.
To do this, you do it one time, and then you annually we have to pay the state of Kentucky a little bit to recognize our.
You have to register the entity, and even for the S corp and the LLC that don't have to pay taxes, you do have to file what's called an informational tax return, where you tell the government two big things. Number one, how much money did the corporation make? And then number two, who owns it?
Right.
Now, well, here's what's crazy. So let's say our little business made $5,000 and we're 50-50 owners. But we decided we're not going to take any money out. So we didn't get paid, we didn't draw a salary, we had no income at all. We're going to leave the money in the corporation so that we can buy the new snow removal equipment we need. At the end of the year, the LLC is going to show a profit of $5,000. You and me will have to pay taxes on $2,500, even though we didn't take the money. And that's because there's a difference in the law between income and a disbursement. And we earned it, but we didn't take it. We had the right to take it, so we get taxed. And a lot of people get very frustrated with that, especially in a just starting out business, where you're struggling, you're not taking money out, and all of a sudden the government comes over and says, oh yeah, by the way, you owe me. And you're like, but wait, I didn't get anything.
And this is your tax bracket that you're going to pay us at.
That's right. That's right.
Yeah. And that is kind of something that's kind of new. When we started this corporation almost 8 years ago now, is the fact that some people, I've heard terminology, they're striving to lose money in a business. Well, I really have never worked for a company and don't have involvement with a company that really strives to lose money. You try to limit your taxable liability sometimes. And,
right.
And there were years when we would speak with our accountant about, okay, what do we need to do?
Yeah, exactly.
But we didn't try to lose money. We tried to look ahead to say, okay, we're going to need this in the coming year. If we buy it now, it has these tax benefits from depreciation or so
Right.
forth. But that's one of the things that you kind of sit back and because as you pointed out, you may not be handed $5,000, but the government says your company made $5,000 for whatever your stake in the share is.
That's right. And you've got to pay your percentage.
And you've
on
got
the
to put it
tax.
down on your tax
Yep,
form.
yep. And nobody will feel sorry for us lawyers, but it happens to lawyers a lot as a big hit. You'll win a case and get a fee in, but then all that money then rolls into the next case, paying for expert witnesses and whatever. And so there's really no money there at all, and yet you get taxed and most lawyers have to pay quarterly on our income taxes. So it's like, whoa, wait a minute, I don't have any money. Why are you coming after me here? Especially new law firms, you see them hit that a lot.
Yeah. When you least want it to.
Right,
to have.
exactly.
You said that the LLC provision came along in 1998.
1998.
1998, okay.
97 or 98. I'm pretty sure it's 98. Yeah, late 90s. It's sort of and in the law, that's a very recent creation. It as funny as it is, there's very little case law on LLCs. Having been started that late, cases really haven't worked all the way through the systems yet and been appealed and whatnot. So I know I had a couple here in town that were some of the, when we were going to court on them, we couldn't even find another case involving LLCs. So we were sort of it.
But we, as you were pointing out, years and years ago, we were calling it the corporations were set up to limit one's liability, but only until 1998 did we actually have the mechanism that
for the true LLC.
True LLC.
Yeah, we used to then refer to them as C corps and S corps. That was always the terms you would use. You a C corp or an S corp,
Yeah. Are you actually, if you are an LLC, are you actually a C corp?
No.
Excuse me, an S corp?
Nope. You're not a corporation at all.
Okay.
You're a limited liability company.
And then you can set up a corporation that.
Or you could have a corporation, an Inc., an INC incorporated, and then you have the choice of making it a subchapter S corporation. Yeah. And it's really, they're very, very similar, but they're two different, distinct things, Now, one word of caution here, because I get this question a ton. I know we're about to run out of time, but I want to get this in real fast. A lot of people will come to me and say, oh, I need an LLC. Okay, well, how many employees do you have? None. What's your business? Well, it's me. I'm a lawn care guy. Okay, you probably don't need an LLC. And the thing to remember is you're always on the hook for your own personal negligence. So if I'm out mowing grass in our little business, you're the radio and I'm mowing grass, and I'm drunk and I'm mowing at a high rate of speed and I run over a bunch of people at a picnic, that I am on the hook for, and my own personal assets are on the hook for. Where the limited liability comes in, so they're going to sue me, and they're also going to sue the company I work for. Your assets would be protected because you're only liable vicariously. That is, because one of the people in the business did this. But if it were you doing it or me doing it, you're always on the hook for your own negligence. Yeah.
Just like we talked to the government. We always were taught you can't sue the government, but you can.
Sometimes you can sue the king. That's right.
Yeah.
And the last point to make is make sure if you've got an LLC, in addition to following all the rules, that you let people know who they're dealing with. So if you enter into a new contract, let's say you're going to buy some lawn care equipment, you want to make sure that when you sign it, you sign Chad McCoy, member or president or whatever your title is, so they are aware they're not dealing with you, they're dealing with that entity, that LLC.
Okay.
Because that helps with the liability as well.
Okay. So we've covered a lot today in the world of, I guess you would call it almost corporate law.
Business formation,
Business
corporate law,
formation,
yep. Absolutely.
And people that have a question, how do they find you guys?
Give me a call, 502-233-8385 or 1-800-254-4444. Happy to talk to you about any and all this stuff. We do a lot of it. I mean, it's part of being a lawyer that I don't know that people necessarily focus on much, but we do a lot of business formation for folks. And it's always good. I always recommend people get a lawyer involved and get an accountant involved. They're separate. I know sometimes I like to talk about accounting, and I know some accountants like to talk about law, but the reality is we need to stick with what we know and get them both involved, because you can get some really good advice. And it's important to have that all set up on the front end.
Yeah.